and welcome to Virtual Investor Conferences. On behalf of OTC Markets, we're very pleased you joined us for the third day of our Precious Metals and Critical Minerals Conference. Our next presentation is from Arizona Sonoran Copper. Please note you may submit questions for the presenter in the box to the left of the slide, and you can view a company's availability for one-on-one meetings by clicking Book a Meeting in the top toolbar. At this point, I'm very pleased to welcome George Ogilvie. He's the President and Chief Executive Officer of Arizona Sonoran Copper, which trades in the OTCQX Best Market under the symbol ASCUF and on the TSX under the symbol ASCU. Welcome back, George.
Thank you, John. Appreciate that. And thank you to the OTC Markets for the opportunity today. So this is Arizona Sonoran Copper Company, and we're advancing the Cactus Project, a long-life, low-cost copper producer in Arizona. Do make some forward-looking statements, so I'll draw your attention to the cautionary language. This presentation is on our website, so please feel free to review the cautionary language at your own discretion. Several weeks ago, we put out a pre-feasibility study, and we ran the pre-feas using a flat copper price of $4.25 a pound of copper, which is well below consensus and obviously well below today's spot price on COMEX, which I believe is sitting around $5.35. At $4.25, the PFS gave us an NPV 8 after tax of $2.3 billion US dollars, an IRR just under 23%, and a leading capital intensity of just under $11,000 a tonne. Now, this is going to be a conventional heap leach mine with a solvent extraction electrowinning plant. That means we'll be producing copper cathode, which is LME grade A or 99.9% pure, and that can be sold directly to US manufacturers. So it doesn't have to leave the United States to go for further smelting and refining, typically today in China. We maintain a very strong social license with a 87% support in the last perception survey. The asset, a former producing mine, is in Arizona. And we'll talk in the presentation about our 3 deliverables for next year. A definitive feasibility study in the second half of 2026, the amended application or permits for the final construction and development of the mine. And we're currently working on project financing, which we anticipate will be in place in the second half of 2026 when the debt commitment letters are first delivered. If we move on now to the share capital structure of the company, today we have 205 million shares issued, fully diluted 215. We just completed a bought deal private placement a couple of days ago. That brought in approximately 83 million Canadian dollars to the Treasury. So currently today we've got just over 100 million US dollars cash in the bank, and we're fully funded well through the entirety of 2026 and certainly well past a final investment decision. There's 9 analysts currently covering the company. Several of them have not updated their reports on the back of the PFS, but at the moment, the consensus analyst price for the next 12 months is around $5.30. And as I talk to you today, we're trading at $4.20 Canadian per share. You'll notice as well, we have strategic shareholders in the company. Hudbay has a 9.9% position, and Rio Tinto are 6% shareholders in the company. Now, when we put out the pre-feasibility study, it revealed that in the first 10 years of production, we'll see an average annual production of 113,000 short tons of copper cathode annually, or 226 million pounds of copper. If you think about that on a $4.25 copper price, it's well in excess of $1 billion US dollars a year in revenue for the first 10 years. You'll notice as well that we have a 22-year mine life, and that the payback is around 5 years. And what makes this project so unique is that it has a very low upfront capital, and that's because we have a very rich infrastructure in the area. So we have access to roads, power, rail, water. There's a community on our doorstep, so we don't have to construct a camp. And that gives us life of mine free cash flow after tax in excess of $7 billion US. And as we referenced earlier, it'll be simple open pit mining from Park Salyer for the first 16 years of mine life. And when that starts to dwindle, we bring in Cactus West, and that takes us through to year 22. Now, when we put the study together, the 5-day VWAP price on COMEX was 502, and that's why on this sensitivity chart, we're showing what economics look like under a $5 copper price scenario. And you can see there that the after-tax NPV shoots up to $3.3 billion US, IRR now almost at 29%, and $9.5 billion US in after-tax free cash flow. Remember, this is on a company today that has a market cap of only $600 million US. And of course, as I referenced earlier, the actual spot price on COMEX today is around $5.35 a pound of copper. Now, we also show $3.75 here. We've got to consider the downside. We have that on the slide because some of the banks that are looking for the project debt financing, they're still using very, very conservative floor prices when they look at their models with respect to loans or lending to the project. And you can see that even at $3.75, however, we still generate $5.5 billion of unlevered after-tax free cash flow and have an NPV around about 1.6 billion after tax. This next slide shows the production profile over the 22 years. You'll notice that there's a steady ramp up over the first 3 years. And at that time, we're actually putting about 28 million tons of ore on the leach pad annually. And then in some other years where we see some really high grade coming our way, we've lowered the annual tonnage. You can see there in year 5, the annual tonnage comes down to 22 million tons. That's because the head grade reporting to the leach pad is now up at around 0.88 total percent copper. And as I referenced earlier, Park Salyer in year 16 will then have fallen away. And just prior to that, in the darker brown area, you can see we're bringing in the Cactus West tons. We're unable to maintain the 100,000 ton production profile beyond sort of year 15 in this current plan. However, we don't factor in any primary sulfide here. There's an underground mine known as Cactus East, which is not in this plan. And obviously, we would expect to have exploration success over the next 10 to 15 years as we continue to explore. So my intuition tells me today that we're likely going to be able to hold that 100,000 ton cathode production well beyond year 15. And in reality, we're probably looking easily at a 30-year mine life here today. Now, the two charts you're looking at here on the top one, we're trying to show the revenue, the EBITDA, and probably most importantly, the free cash flow generation from this asset. And this is all at $4.25 a pound of copper. So you can see in year -2 and -1, that's the $977 million of upfront capital. Now for that, we're building a 70,000 ton per annum SXEW plant. But as you saw in the production profile, once we go beyond year 3, the production starts to rise, eventually going up to 140,000 tons. So that's why you see in years 1 and 2, there's expansion capital going in that doubles the capacity of the plant from 70 to 140,000 tons. But you'll notice on this project that between years 4 and 14, the average annual free cash flow generation is in excess of $600 million US. The first 10 years are important because when it comes to the project financing, that's the tenor that we're going to be looking for with respect to the debt with the commercial banks and some of the export credit agencies that we're currently talking to. And when we stress test the model at $3.75, we see that all of the debt service coverage ratios are very well covered. And we believe that at $3.75, we're probably looking at 60% debt to 40% equity as far as the overall project financing is concerned. This next slide really touches on some of the reserves and some of the key cost numbers. So there's 513 million tons of reserves at a very healthy 0.52 total percent copper. That's 5.3 billion pounds in reserves. And with a 75% capacity and I think 95% efficiency on the heap leach pad, we're going to be plating here 4 billion pounds of copper over that 22-year mine life. And again, at $4.25, that's well in excess of $16 billion of revenue over the life of mine. We've got a manageable strip ratio of 3.3 to 1 and very healthy C1 cash costs of $1.34, $1.62 all-in sustaining cost. And when we add back in the upfront capital and the taxes, we're sitting at just over $2 a pound of copper. So again, $4.25, if we're producing 200 million pounds of copper a year and we're making $2 plus margin on that, that's the $500 million of free cash flow every year for 22 years on this asset. This next slide is really just a little bit of a comparative slide to show you where we sit with other potential North American developers that are hoping to be in production in the next decade. They're all targeting over 50,000 tons annually of copper production. And you can see on all of these metrics, NPV, after tax, NPV, initial capital, and the life of mine production, the Cactus project shows extremely, extremely well versus our peers. And of course, if we're putting $1 billion into the project in upfront capital, we want to see what type of returns are we getting for our shareholders. And the NPV to CapEx is quite an important number. And anything that's north of 1 to 1 in today's market is regarded as being actually quite good. And you can see on this project, again, at the $4.25 copper price, we're sitting at 2.3 to 1, which is industry leading and in the first quartile. At $5 a pound of copper, remember the NPV after tax was $3.3 billion. So that would be a 3.3 to 1 ratio. When this mine goes into production and we consider the top 10 producers in the US today, you can see that the Cactus project would sit in and around number 4. If we looked at it purely on a cathode basis, this would be the third largest copper cathode producer in the United States. Now, on an annual basis, the US uses or requires about 1.6 million tons of refined copper on an annual basis. At the moment, within country, only 800,000 tons is produced within the US. That means about 800,000 tons has to be actually imported into the United States, typically from Chile and Peru, given their location. They're in South America, and of course, they're the number 1 and number 2 copper producers in the world. But with regards to securing supply chain, obviously this asset is very, very important. And if the Trump administration ever decides to put tariffs on the finished product, which they've threatened in the past, but they never enacted upon, with this product being produced within country, it won't be exposed to those tariffs. So strategically, this is going to be a very, very important asset for the United States and helping them with armaments, defense, green technology, the transition away from fossil fuels and hydrocarbons. And obviously, as we know, modern society cannot function today really without electricity. And the best way to move electrons from A to B is through copper. So a little bit more on the project financing. We engaged a group called Hanneman Partners out of London in the UK in August of this year. We then approached about 15 institutions. These would be export credit agencies, commercial banks that still lend in our space, and some of the private debt lenders. All 15 of them agreed to sign an NDA and came into our data room in October. And the plan of action is that by the first quarter of next year, we want to actually have some term sheets from those specific institutions. We're then going to assess those term sheets and then try and determine if we can narrow that group down maybe to 4 or 5, which will then become the main sort of project syndication group, particularly on the debt with respect to the project financing. In the second quarter, once that group is formed, we bring in an independent engineer. And then over the next 6 months, as we put the final permits in place for construction and development, and then we deliver the definitive feasibility study in the second half of next year, we would then want to announce that we have the project debt commitment letters in place. The way it works in our industry is that we're not allowed to draw upon that. We then have to turn our attention to the equity component first and any other forms of financing. And the beauty of this project is there can be an offtake here, but one has not been awarded. And subsequently, that could be a key core or a foundation of any future project financing. Once all of that is in place, and we believe that by the end of 2026, we'll have those fundamentals in place, we can reach a final investment decision, and it's a 24-month construction and development period on this project, which means that we can realize first copper cathode sometime in the second half of 2029. Now, another key thing about the project that you may not be aware of is it's all on private land. There's no federal nexus here. So when we make applications for our permits, which we've done in the past, once the application is, inverted commas, administratively accepted, in Arizona, it starts a clock ticking. And within 6 months, either the state or the municipal regulator, by law, must give us a response to our permit. So now that we know that between the PFS and the definitive feasibility study, there's not going to be any material changes to the process flow sheet, where we're situating the key infrastructure, the production profile, it's all going to remain as is. We're now in a position where we're making out those amended permits right now as we speak. We believe by the end of January, those applications will be administratively accepted. It'll start the clock ticking. And by June or July next year, we should be in possession of some of the critical permits required to construct and develop the mine. But probably the main one is the amendment to the aquifer protection permit. We've already had that one amended in 2022, late 2021, and that took 5 months from when it was administratively accepted to when we physically received the permit in our Tempe office in Phoenix. So what I've just described earlier is really shown on this slide here. So I think we can jump on to the next one. We've obviously had great performance year to date with respect to the share price performance. We're trading around $4.20 today. But as I said earlier, it's still only a $600 million market cap on a plus $2 billion NPV, meaning that we're trading, based on our numbers, around 0.3 times price to NAV, where most of our peers are trading between 0.6 and 1 times price to NAV. I think one of the big catalysts that we saw this year was the investment from Hudbay Minerals into the company. They contacted us last August on the back of a preliminary economic assessment. They conducted 4 months due diligence and then decided in December that they'd like to invest $20 million. They did that investment in January at a 15% premium to the 5-day VWAP price. It was therefore done at $1.68. And since then, with future financings, they've always followed their money and participated and maintained their 9.9% holding. And I think given that Hudbay is known as a very credible mid-tier base metal producer, and they're very good at building projects. It really gave the management and the project a great sense of credibility in the eyes of the market. This slide really is just to show some of the peers and how we stack up on some of the KPIs. I'm not going to go through every one, but I would certainly say that Arizona is probably a very, very safe jurisdiction. You can see there globally, when we look at the M&I and the inferred, we stack up extremely well. The production profile looks extremely good. And as I referenced earlier, it's got one of the lowest capital intensity and one of the better NPV to CapEx. And that's what makes the project economics just so robust. And look, I think over time, we all know that the copper price is going to continue to march higher, and therefore the economics on this project are going to look even more exciting as we go forward into 2026 and 2027. So lastly, just to recap, this is a quality project. It's a copper porphyry system. It's a known entity, given it was a former producing mine, tier 1 jurisdiction. You've got a management team here with a proven track record. I think the value proposition is excellent, despite the share price being up 200% year to date. There's still a lot of runway for a big re-rate here. The economics look great. And importantly, we're producing a critical metal at the time when the world needs copper, and in particular, the United States. It's low risk, given it's brownfield. As far as mining is concerned, it doesn't get any simpler than open pit mining. The mine's substantially permitted. And obviously, we've got a very strong social license from the community of Casa Grande and Pinal County, which has a history and a heritage going back to the 1960s of mining in this area. So I'm going to stop there, and I think we can open up the floor and start looking at some Q&A. So I've got a question here. What are the de-risking events that investors should focus on between now and 2026 construction decision? I think the main de-risking event for me will be getting the final amended permits in place. So that would be the amended aquifer protection permit, the amended industrial air permit, the amended dust permit, and then the last one will be the mined land reclamation permit, which comes from the Arizona State Mines Inspector, and that's tied into the bonding, and therefore that'll be tied into the project financing late in the year. To me, we've put out a very, very credible technical report with the PFS built from real live data from operating mines. And I don't think the DFS is the main driver next year. I believe it's the project, it's the permits will be the big main driver. And any announcements, obviously, on advancement of the project financing. Next question I've got is, what makes Cactus a low capital intensity project? Well, we touched on this in the presentation. We have access to roads. We've got access to rail. We've got access to power right on site. We've got a community on our doorstep, so we don't need to construct a camp. We've already got wells in the ground, and we've got water in the ground that we can draw upon. Typically, when mines are found, they're in the middle of nowhere. They can be at altitude, particularly in copper, when they're up in the high Andes. And to bring in water from the coast and construct a desalination plant can cost a couple of $2 billion before you've even put one hole in the ground or started to excavate. We all have all of this infrastructure in the area, and that's why we can leverage that and keep the capital intensity low. And importantly, it's open pit mining, which is the most simplest form of mining that you can actually get. Another question we've got here is, have you secured any US government support for the Cactus project? I can tell you that myself and CFO have been to Washington on many occasions. We've met with government agencies, including US EXIM. We can avail ourselves of US federal government money, and obviously we're pursuing that given its very low cost of capital. There's one caveat at the moment, however, and that is that if you take federal money, you fall under some form of federal review, which could be all the way up to a NEPA 404. Now, the beauty of this project at the moment is because we're on private land, there is no federal nexus. We've got defined timelines on the permits, and therefore we know when we're going to go into construction and development and see first cathode. We are hearing, however, from various bodies in the US that the Trump administration is trying to remove those regulatory reviews at the federal level, and at some juncture in 2026, they could be gone. So the guidance that we've been given from those federal agencies has been, put your applications in. If you get the opportunity to take money, you're not obligated to take it. But if at that time there is no federal review, then obviously you can see very low cost of capital, and that would be a great outcome for the company. But I will stress here that without that, the project financing will undoubtedly take place on this mine, regardless of whether we get access to federal monies or not. Another question that's come in is, can you describe your relationship with local community and regulators? Well, the city of Casa Grande was really formed when the mine was first discovered in the late 1960s. We're kind of out in the middle of the northern part of the Sonoran Desert. Casa Grande has grown over the last sort of 60, 70 years to 68,000 people today and is a bustling community. But there's no doubt that when this mine goes into production with 600 jobs being created directly at the mine, with an average wages and salaries that will be between 80 and 85,000 US dollars a year, these are high paying jobs with a lot of money going into the local community. You can imagine that there's a lot of support to see this mine proceed forward. And I think in the model at $4.25, over the 20 odd years of mining, we actually generate in excess of $2 billion US dollars in various taxes, which are paid to the municipality, the state, and the federal federal government at $4.25 copper. Another question that I've got here is, what is the track record of the management? I'll spend this on myself, given how I'm the CEO, the leader of the ship. Mining engineer, 31 years of experience. Previously, I was with a company called Battle North. After 4.5 years of getting that broken story fixed, the company was ultimately sold to Evolution Mining for the highest share price it had ever seen. All cash offer. I think it was a 45% premium to the 20-day VWAP. Prior to that, 10 years ago, I'd gone into Kirkland Lake Gold that had the Macassa mine in the northern Ontario. Again, it was a broken story. The share price was $2 and change, 200 million market cap, and 3 years later, it was 1.5 billion, and the stock was at $14. 3 years after I left the company, that company went on to actually be worth 10 billion and was sold to Agnico Eagle. So if you were in at $2, you would have realized the 35 bagger on that one. So it was a great outcome. And then prior to that, it was a company called Rambler Metals and Mining on the Baie Verte Peninsula. It was an old abandoned mine that had been derelict for 20 years. We eventually got that permitted, financed into production. And that asset known as the Ming Mine sits with Firefly, which is having very exciting results today up on the Baie Verte Peninsula in Newfoundland. So I can see that I'm out of time. I'm very sorry that we couldn't get to all of the many other questions that we have here today, but our contact details are at the end of the presentation on the last slide. Both myself and Alison Doskin, our Investor Relations Director. If you have further questions, don't hesitate, reach out to myself and Alison directly, and we'll be greatly appreciated to answer those questions for you and follow up with you. And I'd like to thank again the OTC markets and you, the listeners, for your very valuable time today and following Arizona Sonoran Copper Company. Thank you.